You see it in the news all the time. The Reserve Bank has changed the OCR. It sounds important, and you hear people talking about what it means for their mortgage, but what actually is it? And more importantly, why should you care? Well, if you have a mortgage, a savings account, or are thinking about buying a property, the OCR has a direct impact on your wallet. Let's break it down nice and simple. Before we dive into the OCR, it's useful to know who actually sets it. That's the job of Te Pūtea Mātua, our Reserve Bank. They are New Zealand's central bank, and their role is to make sure our whole financial system runs smoothly. Their number one goal is to keep inflation, that's the rate of your cost of living going up, low and stable, aiming for a target of between 1 and 3% per year. They also act as a bank for the banks. Your bank, whether it's Kiwibank, Westpac or ASB, holds funds with the Reserve Bank and can borrow from them. That's a key reason why they are so influential. The official cash rate, or OCR, is New Zealand's main interest rate. The easiest way to think about it is like driving a car, where the car is our economy. Our Reserve Bank, Te Pūtea Mātua, is the driver. Their job is to keep the car moving at a safe and steady speed, not so fast that it overheats and not so slow that it stalls. The OCR is how they use the accelerator and the brake. If the economy is going too fast, high inflation where the cost of living is rising too quickly, the driver gently taps the brakes by raising the OCR. If the economy is sluggish and risks stalling, the driver presses the accelerator by lowering the OCR to give it a bit of a boost. So how does tweaking this one number affect everyone else? The OCR is the wholesale rate at which commercial banks borrow money from the Reserve Bank and from each other. Think of it as the base cost for the banks themselves. So, if the Reserve Bank increases the OCR, it becomes more expensive for your bank to borrow money. Naturally, they pass that cost on to us, the customer. This means that interest rates on things like floating rate mortgages and business loans go up. On the flip side, if the OCR goes down, it gets cheaper for banks to borrow, and they usually pass those savings on to us through lower interest rates. This is the part that really matters for your household budget. When the OCR goes up, for borrowers, it's tough news. Your floating mortgage rate will likely increase, meaning your repayments go up. If you're due to refix your home loan, you'll find the new fixed term rates are higher too. For savers, it's good news. Banks will offer you higher interest rates on your savings accounts and term deposits where your money works a bit harder for you. For the property market, higher mortgage rates can slow the housing market down. It becomes more expensive to borrow, which can reduce buyer demand. And when the OCR goes down, for borrowers, it's great news. It becomes cheaper to borrow money, your floating mortgage payments might decrease, and new fixed rates will be lower. For savers, it's not so great. The interest you earn on your savings will be lower. And for the property market, cheaper borrowing can speed the market up, encouraging more people to buy and potentially pushing prices higher. So, in a nutshell, the OCR is the Reserve Bank's main tool for managing inflation and keeping our economy stable. It's the accelerator and the brake used to steer us through the economic ups and downs. Understanding what it is and why it's changing helps you understand the headlines and, more importantly, plan for what's ahead with your finances. If you're on the property journey and want to see how the current rates might affect what you can afford, check out the tools and listings on Trade Me Property.